On Business Incorporated today, the World Bank releases $750 million to improve the business environment in Nigeria. In Kenya, Central Bank raises 75 basis points, interest rates by 75 basis points to tame inflation. And Ethiopia's fuel prices rise by 20%. Hello and welcome to the program. I'm Will Ibang. Let's start with markets in Africa, where sentiments were higher today, positive, where the NGX was trading slightly higher at intraday, up 0.05%, while South Africa's JSE rose 0.65%. Elsewhere, Egypt closed trading for the week on Thursday in the green, up by 1.29%, and Kenya closed Thursday's session negative, down by more than 1.5%. In the Middle East, most major equities were closed for the week on Thursday, except for markets in the UAE. The Abu Dhabi and Dubai indexes traded in opposite directions at intraday. The Abu Dhabi was up Dhabi was down 0.3%, while Dubai's index rose 0.78%. Now, still within the region, both Saudi Arabia and the Qatari indexes closed trading on Thursday in positive territory. Now to Europe, where Germany is deploying a massive financial shield to protect households and businesses from soaring power costs. The country finds itself as in an energy war over prosperity and freedom against Russia, as a government official put it. Here's DW's Chris Kober with more. Chris, what does this move entail?
It involves a gas price cap and a plan to cream off windfall profits made by energy companies. Now, the subsidy package is worth up to 200 billion euros, or around $190 billion. How specifically this cap is to be implemented is something that an expert panel is discussing over the next couple of days. Most likely, households and businesses' energy bills will be financially supported up to a certain amount. Should that be exceeded, then real market prices would have to be paid. Confidence amongst businesses and consumers has dropped dramatically in recent months as Germany slips towards a winter recession, as well as rising household bills. Some businesses have been forced to rein in production or operate at a loss as their energy costs soar. Germany's Chancellor Olaf Scholz of the Social Democrats also announced that the government would be scrapping a controversial gas levy that would have allowed energy companies to pass on rising costs and stabilize their business. As bold as this price cap and particularly its size may seem, it is a controversial move. Leading economic research institutes have warned that a gas price cap could further fuel inflation, which hit a record 10% in September here in Germany. And some analysts have also been warning that a price cap would rob consumers of a reason to limit their usage, just as the government is imploring households to make every saving possible over the winter. So it will be interesting to see at which amount the government is drawing the line, and whether the gas amount subsidized by the state will be the same, say, for a single household or for a family of four. Germany's economy Minister Robert Habeck from the Greens is already warning that the price cap will not be able to absorb every difficulty. We are still in this emergency, he said. If we don't save, if households don't reduce consumption, we still risk not having enough gas in the winter.
Chris, a 200 billion euro shield, that's massive. How does the government want to pay for that?
It is indeed a steep figure. 200 billion euros is the equivalent to almost half the size of Germany's federal budget this year. Germany will have to take on new debt to finance the measure. And that has been one of the sticking points. An agreement for this new package only emerged after weeks of haggling within the three-way coalition between Scholz's Social Democrats, the Greens, and the Liberal FDP. The money Germany will have to borrow from investors will not be attributed to the federal budget. Instead, the 200 billion euros are to be pumped into an economic stability fund outside the government's main budget, allowing Berlin to stick to constitutional debt rules, which limit public deficits, which is a red line for Finance Minister Christian Lindner, who's also the head of the business-friendly Liberals. So it is somewhat of a distorted picture. The government claiming it is sticking to its constitutionally enshrined debt brake while actually taking on new debt. Apart from that, EU governments are hoping for extra revenue thanks to a windfall tax EU leaders have been discussing. Under the plan, these companies refining oil, gas, and coal, which have been profiting from surging prices, will be asked to give back a share of their profits above the average of the past 4 years.
Chris, can you give us a look into how financial markets are faring today?
We see a bit of a rebound on German financial markets, the DAX gaining around 0.6% in the early parts of today's trading session. But all of it is based on pretty shaky ground. Amid recession fears and inflation pressure, markets have had a dismal month. And depending how today goes, could be posting their worst September performance in 14 years. The DAX has so far lost more than 6% this month. And in the United States, the Dow Jones Industrial Average has shed more than 8% throughout September.
Thanks, Chris, for the updates, and thank God it's Friday. Now we'll move over to Asia, where shares were mostly lower on Friday, the last day of the third quarter, following another sell-off on Wall Street overnight. China's official factory activity data unexpectedly expanded in August, beating estimates. In Japan, the Nikkei 225 slipped 1.83%, and the Topix index fell 1.76%, while Australia's S&P ASX 200 lost 1.23% to close. Now, the Hang Seng Tech Index in Hong Kong was 0.27% higher in the final hour of trade, while the Hang Seng Tech Index dropped 1.05%. Mainland China's Shanghai Composite shed 0.5%, and the Shenzhen component was 1.29% lower. The Kospi in South Africa declined 0.71%, and the Shanghai Composite was 0.13% lower. Now, stock futures rose Friday as traders tried to rebound from sharp selling this week that brought the S&P 500 to a new 2020 low. The futures tied to the S&P 500 were up 0.87%. Dow Jones Industrial Average futures were 0.72 and 0.13% higher. Well, now let's take a quick look at yesterday's trading activity with our correspondent, Maria Bird.
The U.S. stock market was lower on Thursday as the Dow Jones was down by 1.54%. The S&P 500 was lower at 2.11%, and the heavy tech NASDAQ was down to 2.84%. All three indexes suffered on Thursday, as it was a direct response to the Treasury yield rate climb. It is clear that the market is taking a major hit over the last few days. This is due to the global slowdown that we're seeing in the marketplace. The U.S. stock market still has a long way to go, as many rates are the lowest we've seen in weeks and months.
Thanks, Maria. Oil prices were little changed in early trade on Friday, but headed for their first weekly gain in 5 weeks, underpinned by a weaker U.S. dollar and the possibility that OPEC Plus may agree to cut crude output when it meets on October the 5th. West Texas Intermediate crude futures for November delivery rose 6 cents a barrel to $81.29 a barrel after falling 92 cents in the previous session, while Brent crude futures for November, which expires on Friday, inched up 2 cents to $88.51 a barrel after losing 83 cents in the previous session, and the more active December contract gained 1 cent to $87.19. Both Brent and WTI are on track to rise about 3% for the week, their first weekly rise since August after hitting 9-month lows earlier in the week. For all of September, Brent is set to drop by 8%, down for a fourth month. Now, gold prices edged higher early on Friday, supported by a pullback in the US dollar. But the Federal Reserve's commitment to stay on an aggressive rate hike path kept the metal on track for a 6th straight monthly decline. Spot gold was up 0.2% at $1,663.79 per ounce, while prices are headed for their biggest weekly gain in 7. It is down 2.8% for the month so far. U.S. gold futures rose 0.3%, spot silver rose 0.2%, platinum was steady at $865.46, and palladium was up 0.5% at $2,211.59. Now, Africa's power situation and the opportunities for investment came under spotlight at the International Trade and Investment Forum 2022, organized by the Foreign Investment Network on the sidelines of the UN General Assembly in New York. Attending this year's event were global leaders, finance experts, and bright minds in forward-thinking solutions for Africa's perennial power problem.
Dr. Nyosi Okonjo.
The FIN International Trade and Investment Forum 2022, with the theme Power for Africa, was organized to serve as a launching pad for the international business community to explore investment opportunities for Africa's power sector.
Thank you, Susan.
Discussions were broken into several panels to address the need for international partnerships. Direct Investment Consultants and Group Chairman, Foreign Investment Network, Olayinka Fayomi, and U.S. Councilwoman Mercedes Narcisse set the scene for the program.
We have the burden to help 43 million youth in Africa who are jobless today just because they lack opportunity to one, opportunity to electricity, two, opportunity to technology knowledge. And I'm hoping that some of us today here will be able to help us to get to that level.
Well, my job is primarily passing laws and passing the city's budget. I firmly believe that what we do at the city council does have a profound effect on international finance. Our work in the city council can accelerate economic activity through business development and fostering the technological innovations, which I believe in, and improve economic and financial condition at home here in our city has a tremendous effect on the strength of the global economy.
With 770 million Africans living without electricity, and much of that number in sub-Saharan Africa, former Nigerian President Olusegun Obasanjo, who joined the program virtually, says it's imperative that Africa and her partners work together to generate enough power to help African development.
I personally believe that the resources are out there. All we need to do is to create the conducive environment for investment to come into Africa, for power generation, power distribution, and of course, power transmission.
Director General of the World Trade Organization, Dr. Ngozi Okonjo-Iweala, who also joined virtually, highlighted the annual investment gap for Africa, hence the need for improved energy access to improve well-being on the continent.
We know that the International Energy Agency has estimated a $28 billion annual investment gap for energy for the continent up to 2030. We also know we cannot industrialize or have a solid continental manufacturing base without energy. We cannot increase our share of world trade without adding more value to our products through that manufacturing base. In other words, our future well-being on the continent is limited by improved energy access.
President and CEO of Amelia, Chetan Dubey, gives artificial intelligence, which will most likely determine the future of the workforce in the world and where Africa will be by then.
Are not necessarily clear as to how to take advantage of those opportunities. So forums like this really provide an opportunity to think about communication channels and education so that companies, so that entrepreneurs find the ways to take advantage of of the opportunities in Africa.
The program continues with panel sessions, which further discuss Africa's energy needs, and ends with an award ceremony to distinguished persons in various industries.
Next, a look at Angola's decision to cut key interest rates after the break. Do stay with us. This is Business Incorporated. Welcome back. Angola's central bank cut its benchmark interest rate for the first time in more than 3 years, and that's going against the global trend of monetary policy tightening. The Monetary Policy Committee reduced the rate to 19.5% from 20%, and that's the committee's first cut since May 2019. Matt Kinniger, practice lead Sub-Saharan Africa Frontier View, joins us to discuss the reasons behind this cut. And now, Matt, good to have you on the program.
Hi, thanks for having me today.
Matt, what is behind the National Bank of Angola's decision to cut rates when all other banks, central banks, global central banks, are hiking rates at the moment?
Yeah, so this is a key question. It's a highly unusual move, as we've been talking about recently a lot on this program, but also seeing around the world. Most central banks are increasing interest rates, partly driven by fears of higher inflation, so an attempt to contain inflation, but also because there's pressure from interest rate hikes in Europe and the Eurozone and the US, for example. In Angola's case, however, we're seeing quite a unique set of economic factors coming together. So what we've seen in the country is inflation is actually slowing. So inflation has slowed every month since the beginning of this year, from a high of about 28% year on year to about 19% at the last reading in August. And we've also seen the Kwanza perform extremely well against the dollar. It has actually been the world's best performing currency against the US dollar since the beginning of this year. It has appreciated by about 30%. And this is because of the country's position of benefiting extremely well from very high oil prices over the last year or so, especially since the war in Ukraine began. So what we've seen is a significant increase in forex reserves in Angola. This has had a very direct effect on the currency, which in turn has pulled down the inflation rate because the cost of imports in Angola has fallen. So the bank, or the National Bank of Angola, is in a unique position at the moment to be able to cut interest rates when most other central banks are increasing.
So you mentioned that the Kwanza has appreciated by about 30% recently against the dollars. No other currencies, emerging economies are suffering at the moment. How do you think the Kwanza will perform over the coming year? Do you think this strengthening of the Kwanza will be sustained?
Yeah, so this is the key question. We have seen the Kwanza level off over the last couple of months. So it's hovering at around about 420 to the dollar after significant appreciation at the beginning of this year. Our view is that we expect it to lose a little bit of value, so it will depreciate slightly and gradually over the next maybe 6 months and next year. But we're not going to see a severe depreciation. And this is because there will be some movement against, there is general movement against emerging market currencies, and the Kwanza will be no exception. But oil prices remain historically high, and oil production in Angola will continue to increase. So oil production had declined pretty much every year for the last decade, but this is now going into reverse. We're beginning to see new investments into oil production, and consequently, oil production has increased for the first time over the last couple of months. And so this bodes very well for forex revenues in the country. And so this will prevent the Kwanza from depreciating significantly. But there is something, and so we do expect to see the Kwanza average probably about 500 per dollar next year. So this is still well below what we were seeing last year, which was about 620. But there's another factor to think about, that is politics. We have seen the election over the last month or so. There's probably going to be a little bit more investor confidence in the market now that the anxiety around the uncertainty generated by the election is over. So this will also support the Kwanza to an extent.
Okay, so now that the election that you mentioned has passed, what can we expect from João Lourenço's second term?
Yeah, so this is a really interesting question because Mr. Lourenço was, he came to power in 2017 as an economic reformer, and there were great expectations put on him, and he actually, to an extent, did manage to liberalize parts of the economy introduce economic reforms, including the liberalization of the exchange rate. And this is why we've seen a significant improvement in access to foreign currency, access to dollars in Angola over the last few years. The expectation or the hope is that there will be more pro-business reforms, more privatization of state-owned enterprises, encouraging foreign direct investment. But unfortunately, Mr. Lorenzo is relatively constrained in terms of his scope to push more aggressive business reform, pro-business reform. And this is because the governing MPLA party performed quite poorly at the election. So it was its worst ever performance since the end of the Civil War in 2002. It got just over 50% of the vote. And as a result, we expect there to be a bit of soul searching within the MPLA party. There's probably going to be a little bit of infighting between the senior ranks of the of the party. And this will mean that Mr. Lorenzo will be a little bit more cautious in advocating for economic reform, especially if it targets vested interests within the government. So we're probably going to see policy continuity, a relatively pro-business stance overall, but we're unlikely to see major economic reform as the MPLA tries to shore up its power base and support in the country.
Thanks so much, Matt, for that update. And we'll continue to track how Angola's decision will impact the economy and how other economies will be performing against, this recent hikes and inflationary environment that we find ourselves. Thank you so much, Matt Kindiger, Practice Lead, Sub-Saharan Africa, for joining us today.
Thanks very much.
And now, still on interest rates, Kenya's central bank has raised its benchmark interest rate by the biggest margin in more than 7 years to anchor inflation expectations at its first policy meeting since newly elected President William Ruto took power this month. The central bank increased the rate by 75 basis points to 8.25%, and that's the second hike this year and the steepest since July 2015. The Monetary Policy Committee made this decision due to sustained inflationary pressures and the impact elevated global risks may have on the domestic economy. Now, the World Bank today approved the Nigeria State Action on Business Enabling Reforms, SEBRA, the Program for Results. The $750 million International Development Association credit will help Nigeria accelerate the implementation of critical actions that will improve the business enabling environment in states. The Program for Results supports the most critical state-level business enabling reforms of the government's SEBRA program. The program is open to all states in Nigeria and the Federal Republic of Nigeria, the Federal Capital Territory, given the ability to take concrete steps towards addressing major business enabling environment challenges. We move over to Ethiopia, where fuel prices in the country rose by about 20% on Thursday, September the 29th, less than 3 months after a previous 30 to 40% hike as part of the phasing out of government subsidies for petroleum products. The government, faced with soaring crude oil prices this year, which are widening the state's deficit, decided to phase out all fuel subsidies in July. According to the government, new prices were set to reflect the international market. In total, since December, petrol and diesel prices in Ethiopia have more than doubled, increasing by 120 and 157% respectively. And that's it on Business Incorporated. Do join us same time next week for another edition. I'm Willie Bang. Thanks for watching.